Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, Greenberg Traurig, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman and Wakefield, First American Title Insurance Company of New York, F.J. Siami, Friedman, LLP, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, Newmark Knight Frank, Sterling and Sterling, Stonehenge Partners, The Moynihan Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. So where are we in the fall of 2009? In a perceived time that maybe the world of commercial real estate is getting better. I'm not certain, so today I've assembled four distinguished individuals who have different perspectives on the state of the real estate market. My guests today include Jeffrey Lenoble, chairman of the real estate practice of the law firm Schulte, Roth & Zabel, Anthony Westreich, President and CEO of Monday Properties, Jeffrey Levine, who's been here many times in the past, Chairman and CEO of Douglaston Properties, and Chairman and CEO of Levine Builders, or should we say Grand Pupa of all companies.
Close.
And last but not least, Michael Brody, who is the President and CEO of Loeb Realty Partners. So, you know, you're a new person to my show. You're a former CMBS. You're a former banker. You have a background that you started in the leasing business. Then you've been around. So how do you look at it, the market today? Because you own office buildings, you own hotels, you own industrial, and some retail. How do you look at the New York market?
Some people, Michael, have criticized me of creating this problem, working in the CMBS business.
I could probably say you did create this problem, but that's not the purpose of today. How do you look at today, October 2009?
We're still seeing, Loeb owns 3 million feet here in the city. We own about another 9 million of office space around the country. We own hotels, shopping centers, apartment buildings, senior housing, self-storage, a little bit everything. Rents are still falling pretty much across most of the markets that we're in. I don't know about value today, Michael, because I don't see anything really trading. But very difficult to access financing and very difficult to sign leases that make economic sense as it relates to the amount of money you have to invest in that lease in order to secure that tenant today.
So let's throw the question to Anthony. You own major prominent office buildings in two markets, basically, New York and the Washington, D.C. market. From what I hear, the Washington, D.C. market is in better shape than the New York market. Where do you see rents off from the beginning, and where do you see values off today?
Probably it's a bit of a tale of, Charles Dickens said, a tale of two cities. You have New York City, the leasing market is obviously very stagnant. There's not a whole lot of activity. I think that over time you'll see that picking up, actually. I'm a little bit optimistic about that. But certainly rents are 20-30% down, base rents in New York City. In Washington, D.C., we've seen a tremendous amount of activity, mostly driven by the government and government-related entities. But we did over 1.3 million square feet of leasing in 2008. And like numbers in 2009. And in many cases, high market rents.
Yeah, I mean, Washington, you had the recent sale that Vornado sold their building at close to $900 a foot in D.C.
Yeah, sort of a net lease sale to German investors.
Right, but you take that into consideration. I mean, you in 2007 bought with Goldman the prominent 230 Park Avenue. Which is a great building, former Hemsley, former Penn Central building. What do you think in today's market, you're not selling it. What do you think the value has possibly gone down based on the fact that there's no financing because there were people like you? Don't worry, we'll talk about the attorneys in a second.
It's all our
What,
fault.
what do you think values have gone down in a building like that, or just in general in New York City?
I'm not sure I'll give you a specific answer, but I mean, obviously anybody who bought anything in 2005, 2006, 2007, in any market, values are down. So certainly our timing on 230 Park wasn't great, although it is a world-class asset, iconic
There are
piece of
very
real
few
estate.
assets like that around. No question.
We were thoughtful on our debt levels. We were thoughtful on our debt term. We were thoughtful on the reserves we put in place to deal with the lease up and some of the capital that we're currently doing. Certainly values are down. Fortunately, we're not marking to market the asset today, so I can't really comment.
Maybe
but
20%.
from where we bought it?
Yeah.
It's impossible to tell,
Okay.
but certainly down. I'll agree with that.
Okay, so Mr. Counselor to the real estate world, so where do you see the market today?
The market, there's nothing really new going on in the market. I think a lot of what's going on now is going to be restructuring, workouts, dealing with all the CMBS problems that exist today, trying to modify loans and not just extend them. People are just extending loans to keep from dealing with the situation. And eventually, you just can't extend, as we were discussing earlier, you just can't keep extending these loans. Something's going to have to be done.
So let's bring that up. You know, you say you can't extend. What do we do about this? I mean, how much we have? $350 billion of debt coming due.
I heard $400 billion in the last quarter
there's certain
of this
numbers,
year,
you know, in this situation. You know, there's debt coming due. I remember my former colleagues. You know, we were a mezz debt. You know, take a hotel, the Palmer House in Chicago. Good example. Anglo-Irish Bank has $300 million in the first debt. Aria Real Estate Partners have $75 million. There's nowhere that you can get debt in Chicago for $400 million. I mean, you can't get debt.
Well, it's a combination of things, right? I mean, you certainly need banking reform. You need to amend the FIRPTA laws and get foreign capital back here. But the issue was people were borrowing equity at debt pricing, and we were all sort of drunken sailors, and we were just levering up our assets, and CMBS lenders were happy to give it because everybody was trying to get money out the door versus being responsible for what happened to it. So you need to have banking reform, you need to have capital back into the system, and you need to have some real economic metrics that allow people to invest in real estate again.
So, Mr. Levine, 30 years in business, celebrating your 30 years in business, starting, you know, after graduating from City College at night in the architect school and being on the advisory board now of the architect school. Where do you see the market today?
Well, as you know, I'm primarily focused on the residential market, something you haven't
That's why we
spoken about
brought
yet.
you on. We had to have some diversity.
Thank you. And I continue to believe, you know, there was a great old story about commercial developers and residential developers. And as the story goes, commercial developers eat very well, but residential developers sleep very well because, frankly, we don't have all the tendency to get up and move out in any given day or week or month. The reality is the residential market, while it has been soft since its
You know,
peak.
you're really envious of the office guys. That's the reality. Stop this.
We're all envious of Jeff.
You know, we're all envious of Jeff.
We
You
want
know,
Jeff.
the reality is the residential market has corrected probably across the board 20% in terms of rentals from the peak, which would probably be the first quarter of '08. But it has stabilized. That's the good news, which is something I don't think the commercial office markets can state. The inability of developers, certainly in New York City, where I have my expertise, to create rental housing, since so much of the money was going for the high returns of condominiums, has led to a lack of residential rentals available. And as this economy corrects itself to the upside, as jobs come back into the marketplace, young people still want to live only in New York. You spoke earlier of the panel that we were on earlier last week. And the reality is there's not many places like New York City for people across this country and across this world to come and live, where in any given week you can attend the U.S. Open, the St. Gennaro's Festival, the fashion show, brand new football stadiums, baseball stadiums. People want to be here, and that is keeping the residential market alive.
Isn't it true that as the economy goes bad, home ownership goes bad, and rental properties go up? I mean, that's typical.
Well, typically that is the case when people go off of condo markets for reasons other than a recession, but this recession has taken all boats low.
We always keep hearing about industries that are supposedly recession-proof. Gaming was one of those that was supposed to be recession-proof. Well, that hasn't proved to be true. And what we're seeing in things like self-storage and in residential is that instead of that, you need the job growth, because that young person who comes to New York, who is filling that niche of the residential rental market, no longer can find a job. I think the statistic I heard was that 70% of the students graduating college this year on graduation day did not have a job lined up when they were graduating. So instead of renting that apartment in New York for their first job as an analyst or as somebody who arranges flowers in a department store or whatever they were doing as their first job, they're staying at home, they're living on campus, they're still with their parents. And until there's job growth, until there's migration of people back into those type of jobs, I think we're all going to suffer in the commercial real estate here in New York.
What I'm curious about, and maybe I shouldn't be asking the questions, but I'll ask the question. In today's environment, because what happened in the banking sector over the last several years, certainly in '07, investment banking has become a four-letter word, right? And so,
Appropriately so.
I'm not of that camp. Certainly, there was a group of them. But has that diminishing of that sector in New York City affected your business?
Well, no, it's really very interesting. Are you saying the lack of jobs in the investment banking sector? The reality is...
New York is one of the reasons New York is sexy is because of the investment banking.
Everybody
Absolutely.
wanted to be an
But what's
investment
happened?
banker.
What's happened?
They don't want to
I
be an
think
attorney.
the
Forget it.
reality
Now they all
is-
want to be an attorney.
Now they all want to be attorneys.
The
That's it.
reality is, in the financial world in general, while our fear of the exodus of jobs as a result of the catastrophes of Bear Stearns and Lehman and so on, it didn't occur in the way we foresaw it. Obviously, bonuses and pay scales are down. But many of the people who work for these other institutions found work resurrecting the banks, resurrecting the loans. So whether they're in
They
distress,
left.
so we've only lost, I believe I heard Mayor Bloomberg speak of the job losses in the financial sector at being roughly half of what they were projected to be. And if that continues to be the case, I think a rebound will not be too far away.
Capital markets have to come back. In the late 80s, early 90s, that recession bred CMBS as we now know it today. Nobody knew in the recession in the late 80s that CMBS was going to be the big wave in the 90s.
Yeah, CMBS started in '94 and grew 30% per year.
Correct. And it
so it's
started
not, yeah.
clearly as a result of the recession of the 80s and early 90s.
Yep.
Something's going to take its place now. The smart guy's going to be there first, and capital
Well,
markets.
it's already happening. I am seeing where I haven't seen development deals that irk me as yet because the numbers are still very difficult. Rents are down, construction costs have come down.
Right.
Also
I mean,
20%.
Anthony brought up the fact prior to the show that the cost to build the tenant improvements are down by 15 to 20%.
of
Right?
course.
At least, I mean,
Yeah,
and that's sort of the good news.
Right.
Not if you're a contractor.
But the smart money, you're seeing a lot of smart money in the form of hedge funds starting to look for these distressed opportunities. These office buildings that are marked down by half, it's like the size sims of office buildings, are great opportunities if you're a long-term player.
If you're a long-term player and you have cash.
You know something? You have long-term players on both sides, okay? Loeb, which was really part of Loeb Brothers going back. Loeb Rhodes going back, and Anthony and his company, they have money and they have investors over there, but they're looking at a certain type of product. I mean, Anthony, we was talking prior to the show, said he looked at 15, you didn't look at 1540, you
No,
looked
worldwide and
at
452,
worldwide, and
yeah.
you looked at 452 Fifth. I mean, so there is a looking, but the big question, and I think David Greenbaum brought it out last week when we did the panel. I said, did you look at any of these buildings? Did you look at the properties down at AIG? He said they didn't make sense, some of these buildings, for the Vornados.
Well,
who have-
AIG is a very
It's a different animal.
unique
Yeah.
building. I mean, it's downtown, it's very large, it doesn't lend itself well to very many uses. I think that what I'm seeing is with regard to residential real estate, the funds are coming in and looking for rental opportunities, and they're abundant. And if you can make a deal work by buying at a discount, by taking advantage of the very low interest rates, what's happening is the distress has not been flowing through to the market yet because these absurdly low interest rates that our federal government is supporting in order to help our economy recover are acting as a narcotic, a painkiller to both the banks and the developers who are holding on to these properties. It's the extend and pretend model where we're all holding on, waiting for the future. And while I don't know that the values will come back, but the price may, in fact, by appreciation and inflation, come back.
I work for somebody, Joe Lester, who I respect a tremendous amount. He's been in this market for 40 years. He's our chairman. He tells me the stories in the 70s when things were really bad, that he bought 521 Fifth Avenue and 529 Fifth Avenue for $25 and $30 a square foot, respectively. The rents in the buildings at the time were about $8 to $10 a square foot. So you're talking about 2.5 to 3 times the gross rents for the values of the buildings because the lenders had lost faith in New York, and were looking to dump their assets at that time. And of course, people like Loeb
We can go to 1994
Yeah,
when
stepped
buildings
in
were in Lower
and-
Manhattan.
but the
being
difference
sold.
then-
And in 1990s, Lehman Brothers sold 498 7th Avenue because
Represented in the
but
70s, New York was
and that was
bankrupt.
$60 a square foot.
But they were still financing then. There were still people making loans.
They gave back 95% financing in order to move them off their balance
Correct.
sheets.
That's what you're not seeing today, and that's what
You-
I
you
think
see,
stifling.
there was an RTC. You know, the government was taking over the properties, then they were selling it. Right now, there's nothing happening.
But they didn't have to value the loans they were selling because they had taken over the institution, so they owned the assets of the institution. Now, with the FDIC portfolio, things are going to be a little different because you have to value before you sell.
The problem is if they value today,
They're broke.
the U.S.
broke.
financial
Exactly.
institution is bankrupt.
Correct.
You know, last week I did a show with lenders, and one of the lenders, I think more than one, basically said that forget the loan to value. We're looking at debt service. We're looking at leverage. Debt coverage is our key. Forget that. And we need a 10, 11, a 12% yield. That's the type of situation. I mean, we're going back to the early 90s in many underwriting situations. I mean, we were talking, I mean, you can't get a construction loan in New York for anything. I mean, maybe for affordable housing. But to get a construction loan, there is one project that's been taking 9 months with close to $175 million of equity, and I was with all the lenders as helping them, not as a broker, advising them to just put together this $230 million deal. It's 5 or 6 lenders, and the guy has so much money in the deal, and nobody still wants to do it.
Well, why? If you're a lender, why would you go chase the spreads and the risk of a construction loan when you
There's
can
so
go buy
much
something
out
So
there.
wait,
else?
so
You have your choice.
So wait, you're exactly right.
It's
so
capitalism.
if you're a lender, why do you even want to lend money?
They don't.
Well, they don't today.
But that's
Right.
the.
I mean, I had a
that's
lender
the issue.
recently, a very large French company that is a big lender and was a big lender and claims they're still a big lender. And I brought a 600,000 square foot asset in the CBD of Washington, D.C. to him, fully leased to the government for 10 years. And I said, will you make a loan on this? 65, 70% leverage, 5-year loan, 25-year, 30-year amortization schedule. Thoughtful loan, what we do. Calls me back a day later, too much concentration risk.
I don't like Washington.
Yeah,
Ed Mo.
I'm afraid of the tenant.
Just didn't
Like
wanna
it's the
make-
U.S. government. They're not in business.
He just didn't want to make the loan.
How big a loan was it?
No, 65% on, is half, was
Of
it
value. I mean, how much gross dollars? $100
$80,
million
$90,
loan?
$100 million. I mean, not right in their sweet spot. What they say they're doing.
Right.
So here's a question that I have. You have money, and you can always find money. And you advise people who have money. So you have this place, you have an island, as people said, Manhattan is an island. You really can't go too far, there's only X type of things. Where would you recommend? I mean, you've invested, most of your office buildings are in Midtown. I mean, you've never really gone downtown.
Nor will we.
Okay.
We're a supply constrained buyer. We're not going to buy downtown.
Now you've owned.
Well, we own things for such a long period of time that it's really hard to compare an investment philosophy today to what the firms
Right,
are doing
but-
over
but
the long
what-
term. We
but-
own 2
but-
Wall Street, for example.
I know you own, but you probably own it at a,
You don't wanna
at
know
a
what we own it
basis.
at.
You probably own it at $2 a foot. I mean, so we're not talking. But today,
be difficult to verify.
if somebody came to you, a sovereign wealth fund or a new investment partner, or somebody said, I really have this money, and I do have respect for an Anthony, I have respect for Loeb over here, and your clients came to you, some of the investors, what would you recommend? What should they buy? What should they go into business with Levine over there to build residential housing? Should they
Well, I don't know
try
if you should build residential housing today, although that's taking away my bread and butter. But buying residential housing at these cap rates makes a lot of sense. It's way below replacement value. The revenue stream is very steady. The only thing you have to worry about, unfortunately, is government action through legislation, and I think our city is understanding that at this point. So I still believe that residential real estate in New York City is a fantastic investment.
Let's, there were my former colleagues and some other funds who made substantial investments in residential housing, thinking it was the greatest market in the world, and now some of them are giving back the keys. They're, the investors like the Florida State Pension Fund wrote off $266 million on Stuyvesant Town, and there are others. So,
Stuyvesant Town would be a great buy today at half off.
I agree it would be a great buy, but
But
At
Jeff,
half off.
Michael, you make, obviously, I mean, this is not a very prophetic statement on my part. You make money in real estate by owning it, for a long period of time. If you can survive the down period, and you're thoughtful about your debt levels, and you're thoughtful about your coverage, you're going to be fine in the long term.
So-
and if you're buying, so the answer to your question, one answer to the question is, if you're trying to buy today and sell tomorrow, and you're not defining tomorrow as a longer period of time, you're gambling. You might as well go to Vegas, might as well go to Atlantic City. If you're thoughtful in your underwriting, you're thoughtful in your hold periods, and you know you're going to be holding on to stuff for a while, you'll do well as long as you're with the right operator. If you're looking at residential real estate, go to Jeff Levine. You'll do great with it.
Most of the opportunistic money that I see is looking at mezz debt in distress.
Everybody is in this mezz debt in distress. You know,
That's-
but the
that's
problem
where-
with
that's where equity
but
was
stop.
2 years ago.
No, the mezz debt in distress is a problem, and the mezz debt in distress is a problem. I'll tell you why. I describe the three tranches of money. Obviously, you have the developers, and unfortunately, in many cases, they are what I call dead men walking. The mezz money, in very many cases, is out of the money, and therefore is
Correct.
simply a barrier to title.
Correct.
And then you
That's
have the
not
senior
distress.
debt.
That's out
but
of the
then
money.
you have the senior debt, and what they are is a negotiation waiting to happen.
Correct.
But the low cost of money is delaying that, and that's where we are.
You know, part of it is like, you know, you talk about extend and pretend. That's what's happening with lenders.
Yeah.
And then there is extend and blend in office leases, right? That's happening in certain situations, which is a smart thing. You know, people are saying that tenants today, and you would see it representing tenants, are stepping their toes into the market looking for spaces. I mean, last year they weren't even looking. They were just denying it and saying, I'll wait 6 more months. But tenants are there, and they are negotiating leases. I mean, you signed leases.
Yeah, I mean, 6, 9 months ago, a year ago, I think many tenants didn't know they'd be in business tomorrow. Most tenants today feel pretty good about their business and where it's going. They've done their layoffs. They've been thoughtful about their cash flow. Things are going well for them. And they also recognize that they're in a period of time where it's a tenant's market. And if they have good representation and they know what they're doing, they're probably going to try and commit themselves today to a longer term lease. And therefore, you do see a lot of transactional activity happening. You do see early renewals happening. And they should be happening, and landlords should be having those conversations with them. So I think 2010 won't be a banner year in terms of base rent growth. You'll see a tremendous amount of activity in New York
I
City.
think that some tenants feel that they're calling a bottom to the market and want
Or
to
close enough.
or close enough where, as we say, we don't care if we buy the building at the bottom, but if it can be bought at 60 and we buy it at 70, we're okay because we own it for 15 years and it doesn't matter if we buy it at 70
I mean,
or
I think
60.
it's like the catching knife. You know, how far do you catch the knife? Falling knife over here. And I think you are correct that people are tenants are saying, you know what? I think it's really down to the bottom. It's reached a pretty good level. And if I can deal with a good landlord, and I think that's another question.
Yeah.
The point is, I would rather deal with a Loeb or with a Monday where I know at least you're going to be there in business, as opposed to somebody else who bought a building in 2008 who has no equity in the deal.
Michael, back to 230 Park Avenue, which is obviously one of the crown jewels in our entire portfolio. 9 months ago, we had 180,000 square feet vacant in the building. That's a 1,400 square foot asset, so that's a lot of vacancy for us. We've done 40,000 square feet of leasing in the last 6 months, and we have 30 out for lease right now. So we were very aggressive over the last 9 months to get these leases done. Now that we're getting down to 190,000 square feet, a manageable vacancy number, we're going to be more aggressive. And therefore, tenants want to talk to us. They should be having the conversation now, not tomorrow.
Hey, look, you also renewed Bobby Vans, right?
Absolutely. You got to have your good steakhouse, right?
You always need a good steakhouse. So, you know, Mr. Levine, you know, you and Mike have something in common. You both like hotels. You're building a hotel, and he owns a couple of hotels. What's your thoughts on the hotel market today?
Well, I'll tell you, I'm very optimistic. As you know, I always am.
You are
about
the
hotel
ultimate
business. But
optimist.
in general, in real estate, you know, I prefer operating business real estate to simple real estate. And what I mean by that is the hotel business, where you have a hospitality component. There's an element of operational difficulty that keeps out the riffraff, so to speak. Taking that further, my favorite business in all of the housing business is the senior citizen housing business. As you know, we're in the assisted and independent living business, and frankly, it's been the best part of my portfolio over these past 2 years because of the fact that there's been no money for new development. The market rate independent and assisted living business, if operated properly, continues to have virtually full occupancy, and with the change in the job market, a significantly lower cost of operation, keeping profits greater. So I like the hotel business as well as the senior citizens housing business because of that difficulty of operating, which keeps out competition.
Boy, it's great to have an optimist on the show. What's your thought about the hotel and the
Hotels, all of our hotel clients are in deep trouble at the moment, and I think hotels will come back first because they're the easiest to come back because they change daily, weekly, monthly. But But
come
I'm
back
not.
first, meaning when. That's the big issue.
Boy.
Depending upon when you see this world, there are some people who believe the world is over, is never getting better, and there's some people who believe the knife is already fallen and it's on the ground to be picked up.
The world will get better. There's no that even a pessimist like a lawyer will tell you that the world will get better.
Until 2012,
But
right?
probably
when Nostradamus-
2012,
Right,
that's
when
But I
probably
can
Nostradamus
tell you that
predicted
in
world
New
going
York
out.
City, that boutique hotels with good branding.
Oh,
whether it's-
you know something? You're starting to smoke too much, okay? I mean, not...
You know I don't smoke.
I know you don't, but the boutique hotels, it depends on what the basis of the boutique hotel is. I mean, if you have a boutique hotel and the cost of a room is $200,000, yes. If you have a boutique hotel and your cost is $700,000 a room, it's going to take a little longer, especially when the average daily rate is only down about 45% in New York over the year to year.
But that's not across the board. The better brands are holding
Try to
occupancy
refinance a hotel in
closer
today's
to 8.
market.
No, you can refinance. We're
You
not
can't
talking
do it.
about refinancing
But there are a lot of
anything.
hotels with
the
a lot of
the
debt coming
cap rates
due.
have changed the refinancing market. It doesn't exist. But if you're still hovering close to 90% occupancy at a lower rate, you can still be successful.
The only thing is, it's like the article I wrote the other day about Long Island City. Long Island City needs 13 hotels. I mean, there's a dire need for 13 hotels, and then they even have one with a rooftop. A pool and a rooftop on the 6th floor, so overlooking.
So you can see all the other hotels.
So you can see the other hotels, or the 17 hotels. I mean, I think it's the market.
There's 13 hotels in Long Island City?
13 hotels. 13 operating hotels, 3 years. So I'd like to say, we've had an interesting discussion on the state of the market. And hopefully, maybe in the winter or early next year, I'll bring all of you back for a different show. But right now, my audience has really got a good perspective on your thoughts on the market. I'd like to thank Jeff Lenoble, Anthony Westreich, Jeff Levine, and Mike Brody. Next week, we have the guys who have the money, allegedly, talking about where they're lending money to maybe to all 4 of you and to some of your clients.
Give us some business cards after that.
They definitely have some business.
I'll
cards.
definitely tune in for that one.
See you next week. Thank
Thank
you.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, Greenberg Traurig, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, Cushman and Wakefield, First American Title Insurance Company of New York, F.J. Siami, Friedman, LLP, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, Newmark Knight Frank, Sterling and Sterling, Stonehenge Partners, The Moynihan Group, Urban American, W Financial Mortgage Fund.